Hello. Welcome to Forex Central YouTube channel. Your way to financial freedom. For more information, make sure to check our other videos in this channel. Before you continue, make sure to like, press the subscribe button, and hit the notification bell icon to receive notification updates every time we upload new videos. Claim your Forex trading course tutorial videos for free. Just press like, subscribe, and hit the notification bell. To receive your free Forex courses, please send us your email address at forexcentralofficial@gmail.com with screenshot of your visit in our YouTube channel. We will send it through your email. Thank you. Now let's go for today's video. Forex Central gives special credit to Mohsen Hassan, CEO of MTG, for sharing his expertise and knowledge in Forex trading. Your dedication and commitment to educating others are truly appreciated. We are grateful for your contribution to this Forex Foundation training course.
So we've talked about risk management and how risk management entails minimizing risk for a given position. Now what we need to talk about is money management. And the difference between money management and risk management is that money management is not for each position, but for your global account. So for your portfolio. So earlier we said, okay, well, we're going to try to minimize risk for a position. So we put a stop loss to limit our loss. But when we put a stop loss, we want to calculate, okay, well, how many lots should we buy and where do we put our stop loss so we don't lose more than X amount of money? But what is that X amount of money that we're willing to lose? Well, that depends. What is our portfolio size, right? And this is where money management comes in. Money management comes in because it tells us, okay, we have this portfolio. We want to make sure that we don't lose it. Okay, so whenever you're taking any specific trade, you got to keep that in mind because you don't want a bad trade to ruin your account. You don't want 5 bad trades to ruin your account. So a very important thing to understand is when you're trading, regardless of how good your strategy is, you can have the best strategy in the world. You are going to lose X amount of times. You are going to lose. For example, when you go to the casino, they win about 52% of the time. They lose 48% of the time. But they're able to play these games that make them win so often that they end up making a lot of money. This is the same thing in trading. I've worked professionally as a trader at different firms since 2011, 2012. So that's about 7 or 8 years now, professionally, right? And across these firms, I've seen hundreds of very, very good traders, the best traders in Montreal. And the best traders I've seen, okay, across all these firms, they all have winning batting averages or winning percentages of about 65%, which is really, really good. Because some people, when they come into trading, they think that they're going to win 90% of the time or 80% of the time. That doesn't happen. It doesn't exist. If you're able to win 65% of the time, you're going to be so rich, right? And you have a good win-loss ratio as well. But these are the percentages that are really good. And again, when I compare it to the casino, I'm like, look, the casino wins 52% of the time and they're making a killing, right? So you don't need to win that much. So imagine this. Imagine you're a great trader and you win 65% of the time. You're so good that instead of it being 50-50, you're winning 65% of the time and you're losing 35% of the time. That's amazing. So it's like basically you have a coin and when you play head and tails, but every time you get heads, you win. And when you get tails, you lose, but you get heads 65% of the time and you only get tails 35% of the time. Great game. The thing is, even if you get tails 35% of the time, there are going to be times where you get tails 3 times in a row, 4 times in a row, 5 times in a row. So even if you have a great strategy, this strategy is bound to lose several times in a row at different times. That's just mathematics. Okay? It's not that you're a bad trader. It's not that you're not good. It's just that it's part of the formula that you lose sometimes. Now, so what are you going to do when you lose 3 or 4 times in a row? Imagine you bet too much every time you played. Then you might wipe out your account and lose all your money. And this is what you don't want to do. So money management comes in because it'll come in and tell you, okay, you know what? We have this great formula that makes you money in the long term, but we don't want to get caught when we lose several trades in a row and lose all our balance. So we need to figure out a way that we don't lose too much money. So when these bad sequences happen, we're okay, right? So when we're looking at money management, just think of it this way. If we lose a percentage of our account, it's very hard to get back from there. Example, if we lose 20% of our account, let's say we have $1,000. We lose 20% of it. We lose $200. Now we have $800. How much in percentage do we need to make to get back from $800 to $1,000? Not 20%, because now we only have $800. We now need to make 25% to get back to break even, to get back to $1,000. Well, what if we lost 30%? So from $1,000 to $700. Well, now if we want to get back from $700 to $1,000, we need to make 43%. If we lose 40% of our account, we would need to make 67%. What if we lost 50% of our account? So you have $1,000, you start betting too much, you have a few bad trades in a row, and you lose 50% because you bet too much. So now your $1,000 became $500. To get $500 back to $1,000, you have to double it. So you need to make 100% return. That's crazy, right? Imagine if you lost 60%, now you need to make 150%. So when you lose too much money on an account and your account shrinks a lot, it becomes extremely hard to bring it back up. So our objective is to never lose so much money that we fall somewhere down here, because then it's too hard getting up. We have to limit how much we're able to lose. So even if we have, let's say, 10 bad trades in a row, right? We have really bad luck. We're a good trader, but we have really bad luck, and we got 10 bad trades in a row. It's not the end of the world, because we only lost a little bit, and then we're able to make it back, right? But if we're betting too much and we get 10 bad trades in a row, then we lose everything, and then there's no way of getting back from that. And this is the problem with most novice traders. They bet too much, they blow their accounts, and they don't stay in the game to keep playing. And this is what we want to avoid. So we're going to add on top of this in the next lectures and see how we use money management techniques to protect our account and to calculate our position sizing, how many lots we should buy in order to not lose too much. So now it's time to talk about position sizing, which is basically how many lots or partial lots should we buy for a given position. Now, when we looked at money management, we said that we didn't want to lose too much on any given trade to not lose too big of a percentage of our portfolio. Now, because of this, whenever we're doing position sizing, we have to specify what is the percentage of the portfolio that we're willing to lose on any given trade. Now, you can set your own percentage, but the general rule of thumb is to use somewhere around 2%. What this means is that you should be willing to lose a maximum of 2% of your portfolio on any given trade. Now, you can play with this, right? Some people are gonna be willing to take more risk and they're willing to lose a little bit more than 2%. Some people don't want to take as much risk and want to lose less than 2% per trade. For example, imagine you are using the 2% max loss per trade and you have $1,000 in your account. That means you're only willing to lose 2% of that $1,000. And 2% of $1,000 is $20. That means you're only willing to lose $20 per any trade on your account, right? That means even if you lost 10 trades in a row, even if you have 10 bad trades in a row, you would lose 2% on each of them, which would be 20% of your account, which is, you can easily come out of that and have a series of good trades and be profitable. So if you use 2%, you're basically saying that even if you have 10 bad trades in a row, you're only losing 20%, and you can get back from that. Now, if you have a very small account and if you're taking 2% risks, you're not making enough money, and then you want to take a little bit more risk because your account is small and you want to just temporarily take a little bit more risk, you can do that. Generally, when you have more money, you're even going to take less than 2%. So if you have, $50,000 or anything like that, you're going to take less than 2%. So imagine you have $100,000 in your account. You could be like, well, you know what? I want to take 1% max loss per trade. So if I lose 1,000. So even if I lose 10 trades in a row, I'll lose 10,000. I'll still have 90,000, and I can get that back very easily. So you can play with that as you want. I suggest that you start with the 2%. because you are going to be starting paper trading anyways, so it's fake money, but just so you see how that affects you. Now, once you have your percentage decided, and we're going to go with 2% here, the steps are this: to calculate how many lots you want to buy. Step 1 is going to be calculate the dollar max loss for the position. In our case, let's assume we have $1,000 in our accounts, because that's how we're going to go ahead and practice here. We're going to start as if we only had $1,000. So 2% of $1,000 is $20. So for me, the maximum amount of dollars that I'm willing to lose is $20 per trade. Okay. Step 2, I'm going to have to decide on my entry price. Step 3, I'm going to have to decide on my stop loss price. Again, you see, I'm not talking about profit. I'm only talking about about loss here. And then I'm going to calculate my position size. And this is the formula to calculate my position size, which is going to be my max loss, which is the $20 here, divided by my entry price minus my stop loss price, divided by 100,000, because that's going to be one lot, the value for one lot, times the entry price. And don't worry, you're not going to have to do this calculation every time that you're going to do a trade. In the next lecture, I'm going to give you a calculator that does all the calculations for you. But we still have to go through it once here so you understand how it's calculated. So let's imagine this. Let's imagine I'm getting on this trade. Okay. Let's put a 4-hour chart, for example. So I'm just going to draw some lines and pretend we're going to do a trade here. Let's say this, and we'll do whatever, okay? Doesn't matter. Let's see, there's a little support here. Might be a little bit of a range. Oops. Kind of, I guess. Okay, so let's say we're looking at this, and we're like, okay, you know what? I wanna do a trade here. I want to buy if this currency falls here somewhere, because there's this range here that I want to trade. I think I could buy here and sell here, buy here and sell here, and do multiple trades like this. So let's say I want to buy if the price falls here, right? Now, if it goes back up, I'll take my profit here. But again, we don't care about profit now. If it goes down, I'm going to take my loss. If it goes down here, below these two supports. So if it goes here, I'm going to take my loss. And again, I'm just doing whatever for example's sake, right? Don't disregard these lines. I just put whatever, which they don't look too bad either. But let's say I want to put my stop loss here. Okay, so if it falls down, I'll take my loss. So my entry price is going to be, let's say, just above here. Let's put it just above this. You'll see that round numbers actually have a big impact, right? I have 134, and you see that it's kind of a support. So let's put it just above 134. Let's put it 134.06. I'll try and get in at 134.06. Let's just put this in text. So I'll do buy at 1.3406. That'll be my buy price. And then my stop price is going to be, let's say, somewhere around here, 133.57. 133.57. Let's put this in red. That'll be my stop. Okay, now I can calculate how many lots am I going to buy. Okay, and I'll use the formula that we just looked over here, right? I'll just use this formula here. So the formula will go like this. Let's open up a calculator. And we'll go here and we'll put my max loss is what? Is $20. That's what we said. Then we have divided by, and we open parentheses, we have our entry price, which is 1.34006, minus our stop loss price, which is 1.3357, close parentheses, and then we take this number, we divide it by 100,000, and then we multiply it by the entry price. So times the entry price, which is 1.357 0.4006, and that gives me 0.061. So I can buy 0.06147 lots. Obviously, your broker isn't going to permit you to have so many decimal places, so you can get 0.06 lots. So you just round it down, 0.06 lots. And if you get this, if you're able to get this amount of lots, right? If you had it exactly, then if the price goes from here and you actually lose, well, 0.06 lots times this amount of pips that you're going to lose is going to give you a $20 loss. So basically, we were able to calculate the exact amount of lots that we should buy, which is in this case 0.061. That will make it that if we do lose and we do take our loss at that price, we will lose the exact amount that we had calculated before, which is the optimal amount that we're willing to lose, which is $20. We don't want to lose more than that. And because of this, we were able to figure out that we want to use this amount of lots so we don't lose that amount of money. So the process you see is very simple. You look at a currency that you want to get into. You know how much money you're willing to lose, in our case, $20. You look at where you want to get into that currency. You find where you're willing to take your stop loss, which is going to be basically outside of some support level, somewhere where you think the currency is going to have a hard time reaching. And based on that, you calculate what is the position size, how many lots you're going to be able to buy in order to not lose more than that $20 that you don't want to lose more than. Very simple. So this was an example of how to calculate your position sizing for a long position. So when you're buying something and your stop loss is below it. Now, if you were actually shorting something and basically you're shorting somewhere, let's say here, your stop loss would have been higher. Now, if this is the case and you're shorting something, the formula is very much the same, but for something small. In this situation, if you're shorting something, your stop loss is higher. So what you have to do is you actually have to do the stop loss price minus your entry price. Otherwise, it would have given you a negative number. So that's the only difference. You can play around with it and calculate it for a short position and see what you get. But I'm not going to ask you to do this calculation every time. I actually don't even, put it into my calculator every time because you can just use a calculator that does that for you. And this is what we're going to be looking at in the next lecture. We're going to be looking at how you can get this calculation done very quickly and efficiently without having to do all of that. So, resources time. I'm going to give you a few resources that you can use to calculate very quickly and efficiently your exact position sizing instead of taking a calculator and calculating it yourself every single time. Now, these two resources are going to be one, this Excel sheet that I've made for this course. And you can download this Excel sheet by clicking just under the lecture in the resources section. And you can just download it. It's an Excel file. And you can use this to calculate your position size. After I show you how to use this Excel sheet, I'm also going to show you a website that you can use, which is this one, where you can calculate your exact position size, very quickly and efficiently. I'm actually going to recommend this website for position sizing over my Excel sheet because, I'll answer the reason for that why as we go through the Excel sheet. But you have both of them. So watch how I use the Excel sheet and then watch how I use the website. And then you can use whichever one you want. So the way this Excel sheet works, and we're going to go over the Excel sheet later on because it has more purpose than just position sizing. You're also going to use this to keep track of your performance, but there is a section for it for position sizing. So this is how this Excel sheet works. You have this section here, which is basically for position sizing. And in this section, you have a few things that you can fill out and a few things that you can't fill out. Whatever is in light blue is what you can fill out. All the rest do not touch. There's formulas in there, so it automatically calculates the rest. Okay, so you don't want to touch anything that's white because there's formulas in there, and it has calculations in there. So if you play around with it, you might break it. That being said, the ones you can play with is the ones in blue, and these ones you have to fill. So account balance. We said that our account balance was $1,000. So you put 1,000. Max loss per trade. We want 2%. So we leave it at 2%. So you see here, it tells you that your max loss per trade is $20. If I want to go 1%, then it would be $10, but I'm leaving it at 2%. Your margin access. The margin access is how much your broker gives you to trade with. With Wanda, the margin is 50, so I'm leaving it at 50. If you have 200 to 1, then you can put it here and it'll tell you how much capital you have access to. I'm leaving it at 50, so I have 50K capital. The currency pair you're trading, we are going to be trading this one, which is USD CAD. So I'll just put USD CAD. This doesn't actually do anything, so you don't really need to put it, but it's just for you. Now you have to put entry price and exit price. And you have to go if you're long or short. So if you're long or short, I'm going long, so I'll leave it as long. My entry price, what is my entry price? Is 1.34006. So I'll put this here, 1.34006. And my exit price is 1.33570. So 1.33570. Enter, and you see here, it's going to calculate a few things. It's going to calculate the loss in pips, how many pips I'm willing to lose. And it says here, I'm willing to lose 43 pips. And you can see that the difference between this and this is about 43 pips. Now, it'll calculate how many lots I should buy, right? And in this case, it tells me you should buy 0.6147. And remember our calculation here, 6147. So it's correct, right? So instead of you doing all of this calculations, this Excel sheet is going to calculate it for you. And you see I have the formula here. If I'm long and if this is more than this, then do this calculation. If I'm short, then do this calculation. I set it all up here, okay? Now, I can't buy 0.06147 because with my broker, I can either buy lots, mini lots, so I can't just trade this. With my broker, the minimum amount I can buy is 0.01 lot. So that's the minimum. So I can go in increments of 0.01. So I'm going to round it down and I'm going to use 0.06 lots, okay? So that's, that's the optimal amount of lots that's been calculated. And this is the amount of lots that I'm actually going to use because I can't use this optimal amount. Now, it's going to calculate some other size. It's going to calculate my contract value. So how much is it going to cost me to actually get this amount? It's going to cost me 8K. That's okay because I have 50K, my capital that I have access to. Then I have other calculations like the pip value. So I know that the pip value is 60 cents. So that's each pip is going to cost me 60 cents. Pip value in base currency. Then margin requirement. How much margin do I need for this position of 8,000? Well, I need about $160. That's cool because I have 1,000. And then the max loss per trade. How much am I actually going to lose if it goes against me? Well, guess what? I'm losing just less than $20. I ultimately want to lose $20, but since I couldn't get the exact amount here and I got a little bit less, I'm going to be losing a bit less. If I was able to get this exact amount, 0.06147, I would have lost $20. But since I can't buy this whole amount that I want and I can only buy 0.06, I'll lose just below $20, which is okay, right? So this calculates it for me. Now, you can use this for your calculations. There's a little bit of a problem. And the little bit of a problem is I'm assuming that my account balance is in US dollars. So, if you're trading somewhere else, if you're in India or if you're in another country and you're using your local currency, then you have to convert that currency to USD, or you have to make some changes to the calculations, which is a little bit hectic, and it would have taken me too much time into putting all these formulas here because, it'll just take so much time. So you can just use a calculator like this if you're not using base currency US dollars. And here, example, if I was trading in Canadian dollars, I could use this calculator, or if you're using any other currency. So if I'm trading Canadian dollars, I'll put Canadian. My account size, I'll put 1,000, which is 1,000. Risk ratio, I'll leave it at 2%. How many pips can I lose? Well, here I can use my Excel sheet, or you could have just looked at the chart and did the entry price minus the exit price, right? So here, how many pips are you willing to lose? Well, your entry price was 1.34006, exit price is 1.3357, and what you're willing to lose is 43.6, and you have it here, loss in pips, right? So here I'll put 43.6, and then your currency pair that you're trading, you put it in, so it's USD CAD in this case, and then you calculate. And you see here that the calculated amount, if I want to lose only $20 Canadian, is 4.6, is 0.046 lots. So how come is it different than what I have here, the 6.1? Because here it's assuming my currency is Canadian. The balance that I have is Canadian dollars, not USD. Here it's assuming I have $1,000 USD. And this is why I'm telling you, if you are trading with your currency is in actual US dollars, it's cool. You can use this Excel sheet. But if you're trading in another currency, your account balance is another currency, well, then it's not going to be the same amount because you want to lose 2% of, not in US dollars, but in the currency that you have, right? In this case, if my currency was USD and I recalculate, you see where it gives me here? 0.62. which is what I have here, right? Rounded up, rounded at 6.2. So my Excel sheet is going to work if your balance that you have is in US dollars, which, you know, I think about over 50% of my students are in the US. So you can use that Excel sheet. Otherwise, if you are keeping your currency in another currency, since I couldn't do all the combinations here and pull the exchange rate for each currency and not make it too complex, use this Excel sheet, put your account currency in, and you'll be able to do the same calculations that you get from the Excel sheet on this calculator. Now, where can you get this calculator? On the Forex resources sheet that you already have. It's right here in the other resources, my FX book. You can just click on it and it'll open, and it's your position size calculator that you can use. So you have these two options to make your life easier.